Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is November 6, 2022. I want to begin with a segment on Sam Bankman-Fried and FTX. I covered this 2 weeks ago, but the story continues to unfold, and there's some angles I want to cover this time. And so we'll start with that, and then I'm going to get into quite a bit of economics and what's driving the market. The Wall Street Journal, Alexander Osipovich interviews Sam Bankman-Fried. He flew down from New York down to the Bahamas to meet with him, and so this is a one-on-one interview that he does. I want you to listen to this, and as I played this and I replayed it, and it was hard for me to follow this guy. He speaks, Sam Bankman-Fried speaks in the past perfect and future perfect tenses, and remember English classes, learning about past perfect and future perfect. It's kind of an interesting way to phrase sentences. He uses hypothetical situations to describe his actions, and he is, in my opinion, very hard to pin down. It's interesting because he has a very soft-spoken voice, kind of a compelling voice, a likable guy, and it makes it appear that he is honest and forthcoming. However, as facts come out, the things that he says, I can't tell which ones, but quite a bit of them are lies. But he says them in kind of a compelling way, in a way that sort of sucks people in. At the end, he talks about dollars being fungible. Now think about that. Fungible. What is that? That's when you move one asset to another asset kind of very quickly and seamlessly. One asset becomes another asset. We're not used to that. We're thinking in terms of, okay, dollars, and if I want to go buy gold, I exchange my dollars for gold, and then I acquire gold, so it's not fungible. It doesn't just slide into another asset, but he talks about that. And then he claims in the interview that the 32 billion assets were taken by his ex-girlfriend, Caroline Ellison. Now think about that. His ex-girlfriend, live-in girlfriend with all the other people in their big apartment living situation, she takes 32 billion. That just seems weird to me. Listen carefully. I think you'll find this interesting.
As we've learned about what happened over the past few weeks, we've learned that there were some issues involving where customer funds were put for FTX and some accounting issues. Can you walk us through what the problem was on that side?
Right, you rewind to 2019, 2020, FTX didn't have bank accounts. And that was because as a global crypto exchange at the time, almost none of them were able to get, global banking. Some customers still wanted to onboard fiat currencies though. FTX was maintaining cryptocurrency wallets, but not banking accounts. And so some of them would wire money to Alameda and then ask to be credited on their FTX account.
How much of this customer money was wired to the Alameda bank accounts?
I don't have the numbers in front of me, but my estimation is I think more than half.
More than half?
More than half of Alameda's total position came via that method.
So how many billions of dollars are we talking about, at least ballpark?
I think north of 5.
And so this was actual US dollars that customers transferred to Alameda bank accounts,
Yeah.
and they were credited for it on FTX.
Yeah, that's right.
So more than $5 billion were transferred into these Alameda bank accounts.
Yep.
It was then credited so that customers saw that they had that balance
Right.
on their screens.
Yep.
What actually happened to the dollars sitting in those bank accounts?
One phrasing of it one could use would be to say that Alameda effectively sent those dollars from its FTX account to the user, but that's a ledger transfer, of course. Outside of that, the answer is they were wired to Alameda. I can only speculate about what happened after that.
So you don't know what happened to those $5 billion?
They were wired to Alameda. I wasn't running Alameda, but I can now go back and take a guess at what, where they were ultimately spent or used or something. But dollars are fungible with each other. And so it's not like this $1 bill over here that you can trace through from start to finish. What you get is more just omnibus pots of assets of various forms.
Was there double counting going on?
There was not double counting from FTX's financials. FTX's financials were correctly, effectively debiting this amount from total customer balances on FTX.
So let's say Bob wires $100 to one of these Alameda bank accounts.
Mm-hmm.
Bob checks his FTX screen. FTX has credited his account.
That's
and
right.
says he's got $100.
Yep.
But behind the scenes, Alameda goes and does something
Right.
with that money.
Yeah. Alameda has -1. Was it $100 that?
$100.
Yeah. Alameda then should have -$100 on FTX, right? Because effectively, or at least that would be one way to mechanic this, right? Would be Bob sends to Alameda over here off of FTX through a wire transfer. Then on FTX, Alameda sends to Bob. But the whole key there is you need to keep track of that negative Alameda piece, of the fact that Alameda is crediting other people, thus that should be debiting from the funds that they have on FTX.
So this problem developed in which more than $5 billion of user funds was sent to Alameda, and it was not properly seen in the systems. It made Alameda's position seem much
Less
larger.
large than it was.
You only became aware at the beginning of November?
I don't remember the exact date, but it is somewhere around there, yeah. I was surprised at what happened when you added those numbers together. I don't know exactly when that notional became so large, that wire transfer piece. I think it was surprisingly recently, given that it was, because this was a sort of legacy system, right? We transitioned away from this system over time, but I think that some people just kept wiring to Alameda anyway. Even after we had built out our own payment networks and removed any traces of that old pathway. And so I think it was maybe surprisingly recently that a lot of that happened as well.
Was Alameda using this money that came in to that account as part of its collateral on FTX?
Not to my knowledge, but I'm not sure.
But that is possible that was how it was being used?
I don't know what they did with which pieces of assets. And given that dollars are fungible with each other at the end of the day, I'm not sure it's even well defined to talk about whether it was those dollars or other dollars that were sent somewhere.
The heat is being turned up on Sam Bankman-Fried from all sides. Regulators, customers, financial media, banks, attorneys, even those within the crypto industry. CNBC's Andrew Sorkin interviews Michael Novogratz. Novogratz is the founder and CEO of Galaxy Digital. They are a leader in the digital asset and blockchain space. He's very credible. He tells it exactly as it is from the perspective from inside the crypto industry. Take a listen.
I sat there still trying to frankly process so many of the different answers that Sam Bankman-Fried provided yesterday. Believable to you? Not believable? What was your immediate thought?
Listen, Andrew, this is a young guy who's certainly in distress. It was delusional. Let's be really clear. Sam is delusional about what happened and his culpability in it. We could all be like dime store psychiatrists, right? There's a lot of narcissism there. There's a lot of grandiosity, but being psychiatrist isn't going to really help, right? He needs to be prosecuted. He will spend time in jail. They perpetuated a large fraud, and it wasn't just Sam. You don't pull this off with one person. And so I'm hoping that the authorities get to the bottom of this faster, not just for the sanctity of the crypto markets, but for all markets, right? Markets are based on trust. And when you have trust broken like this, it questions everyone else, right? People start looking for black swans everywhere. And so in some ways, this is the story of the moment because it is such a giant story, but it's, you're seeing someone who's just spewing more lies. And listen, Sam's always been kind to me. He has a kind demeanor. That was part of the shtick. And I'm not saying he even planned this all like a criminal mastermind. What they did was criminal, and they need to be prosecuted for it.
As I was doing my research, I came across this article from Bloomberg. And the article read, it really caught my attention, Bitcoin sinks further 70% from where it is now. Now it has fallen from 65,000 down to 16,000. I forget what that is. I think it's 75%. And this article says it's going to fall another 70%. Of course, the 70 is calculated from the 16. In Standard Chartered list of possible 2023 upsets. Now, in the U.S., most people are not familiar with Standard Chartered. Standard Chartered is a very large bank in the UK and has about 800 billion in assets, which makes them about twice the size of Morgan Stanley. So very substantial. And they are not just in the UK, they're a worldwide bank doing business throughout Europe and Asia. And their head of global equity asset or global assets commented on this, Eric Robertson. So this is not a fly-by-night company. Eric Robertson is not he's very credible. And so he made this statement based on their research and their opinion. He says that in one scenario, gold, he believes, will surge this next year as crypto falls. As people are looking for alternative assets, they're going to abandon crypto, and in this case, Bitcoin, and will move more toward precious metals. Again, as the bank, they don't sell precious metals, they don't sell Bitcoin. This seems to be more of an independent analysis, acknowledging that people are looking and will look for alternative assets to paper currency. I'm going to move into some economics, and this, the first thing I'm going to cover is the job market. The last Friday, the jobs report came out, and it was positive. 267,000 jobs were added. And so this has continued to be the case, making unemployment still at about 3.7%. So and then when that was announced, the stock market went down. That's interesting. Why would the good news of strong employment, low unemployment send the stock market down? Because in my opinion, the market will see this, or the Fed will see this as the opportunity to raise interest rates with ease. That we have a strong job market, we don't have to worry about it. We'll go ahead and raise rates whatever we need, and the job market and the rest of the market can probably withstand it. So this chart is an interesting chart because it shows the U.S. non-farm payroll employment, not unemployment, but employment. And you can see the trajectory that employment was on for the years beginning from 2018 on up. And then, of course, when the pandemic hit, a lot of jobs were lost very quickly. And from that point, it'd be about May or June, the employment recovered and has been on an upward trajectory ever since. And when you look at that, the last part of it, I put a red circle around it because this would cover the period of time of approximately 2022. So you have the economy is struggling, the stock market went down as much as 25%, and the bond market went down in some cases 30% or more. So the stock market goes down, the bond market goes down, other segments of the economy are challenged, and employment continues to rise. Isn't that interesting? When they talk about the Fed raising rates, they think in terms of where is it going to, and where it's going to before it stops, or as it stops, is called the peak rate. Where is the peak rate going to be? Is it going to be, 5% or more than 5% or whatever? So there's a lot of speculation on that. And so this article said, Fed could be pushed by overheated wages, which we just covered the job market, which wages drive that, to higher peak rates. So wherever that peak rate is going to be, that he sees that the gain in wages and gain in employment, because those are going together, is going to give them the freedom to be able to raise rates more. And then goes on to say, estimated comment that the estimated rate hikes in December and February meetings of the Federal Reserve are likely to be a 0.5% increase each meeting. The title on this slide is Labor Market Hasn't Broken Down Slightly from the Recent Peak. So what this is, it's a Bank of America global research reported through Bloomberg, and it uses the Atlanta Fed's tracker, growth tracker. So the data, this is the labor market, looking at year over year, you can see I circled them in red. The first three down periods are the decline in jobs. Early 90s, 2000, 2003, 2007 to 2009. That corresponds to recessions. Early 90s, small recession, much greater recessions in 2000 and 2008. And then at the end of the slide, look at where we are now. So the job market and wages have gone up radically and have not declined much. So if the job market is going to respond to the recession that supposedly is coming, it has a long ways to go. So I just want you to see the job market, of course, being at a 3.7% unemployment rate, jobs are being added. It's a very unusual environment for a proposed, theoretically, coming recession. So the job market is usually the last piece to follow. We'll see what happens, but I suspect this will come down, but I just can't imagine it coming down like previous recessions. As I said, the big news last week was the jobs report, and what is that and what that is telling us about the economy. The report showed that unemployment remains quite low at 3.7%, as I said earlier. In the upcoming piece, Megan Green echoes a sentiment that the jobs report was quite good. This is good news, but it leaves the door open for more and more rate hikes until inflation is down. According to the Fed, their target is 2 to 3%, and they would like it at 2%. We'll see where that goes. But if you take Chairman Powell at his word, he's not going to stop. His words are, I'm not going to stop until the job is done. The market's reaction to this was negative, at least at first. I'll play this interview that David Weston does with Megan Green.
Always great to have you with us, Megan. So of the numbers that we got out this morning, what really struck you as most important?
Look, I think the numbers that we got out tell broadly the same story, which is fairly encouraging. It's that the economy is slowing down marginally. So we're taking some of the heat off of the economy and hopefully, therefore, off of inflation. You saw that in the income and spending data most of all. And that's the story that is consistent with what Chair Powell had been saying yesterday at the Brookings Institution, which you guys covered. So there is some evidence now that what the Fed is trying to do will happen. The big question is whether the Fed can continue to do this without pitching the U.S. into a recession or not. And the Fed is hopeful that maybe they can avoid a recession. I'm much less hopeful on that, actually. I think we probably will have a recession, but it's going to take a while because there's so much cash in the economy, both among households in aggregate and also among corporates.
So pursue that if you would, Megan. I know you had a column in the Financial Times just today on that. You sort of talked about waiting for Godot. Everybody keeps talking about this recession. It seems to keep putting off and on. Are you confident we will have a recession? If so, when, given the rate of drawdown of the savings?
Yeah, look, this has to be the most anticipated recession in U.S. history. It feels that way. At least everyone is forecasting one, including myself. So I think we are going to have a recession, though. If you look at the U.S. economy in a global perspective, actually, it kind of looks like the cleanest shirt in the dirty laundry basket. Insofar as things aren't great, we're slowing down significantly, but we're actually looking better than most other developed markets. That's partly because Europe is disproportionately hit by the war in Ukraine, but it's also because of the stimulus measures after the pandemic, which left Americans and companies in the U.S. with this huge cash cushion. If you look at all the indicators, though, it looks like that cash cushion is wearing out pretty rapidly now. So, for example, on the consumer side, U.S. households have increased the amount of credit card debt that they have pretty significantly. The jump was 15% in the third quarter. That's the biggest jump we've seen in about 20 years, suggesting that some households really are squeezed and are sticking purchases on credit cards instead of using the cash that they don't have anymore. If you look at loan defaults among corporates as well, that's ticking up. It's also ticking up among consumers. And so it suggests we've been in a good position because of this big cash buffer, but actually it's whittling down. And if companies start running out of cash, their profits start falling as borrowing costs are increasing, they're not going to keep as many people on their payroll rather. And so then consumers will stop spending. It tends to be more whether they have job prospects than whether they have cash in the bank that affects consumption in the U.S. and across the developed world. And so that's when we'll get a recession. I think it will probably happen around the middle of next year.
The factor affecting unemployment rate is wages. Wage growth over the past 12 months is 5.1%. Low unemployment or a tight labor market is causing employers to have to pay up to get workers. Here is BlackRock's Jeff Rosenberg on the cause and effect of low unemployment. He is interviewed by Lisa Abramowitz.
Whether there's a compositional aspect where people on the higher ends are getting hired and there's a shortage, especially with the retirees, and on the lower ends, perhaps it's a different picture. What's your sense of how much that's contributing to the unexpectedly high rise in wage inflation? Jeff Rosenberg, what's your sense of that? Excuse me.
Sorry, I thought Randy might have been off, but I'll take that. Yeah, you always have to look at the compositional effects here, and certainly there may be some of that as Mike highlighted with the retail numbers down and the warehouse numbers down, and Mike, some of that can be seasonal, so that's something we'll have to look in. So there is definitely, when you look at the high frequency data on a month-to-month basis, you can get a mixed shift, and that may be pushing up this number, this 0.55 number. Nevertheless, the bigger takeaway, if you abstract, if you smooth out from the monthly variations, is that the 12-month run rate of wage inflation is still above 5%.
Right.
And so this is really the challenge. And so we're going to get away at some point from this debate about 50 or 75 or really the pace. And the issue is the level of rates restrictive enough? That's really going to be the debate, because right now in the bond curve, the market is expecting rates to be cut by the second half of 2023. So there's a real disconnect between an expectation that we can see the Fed have success on inflation, so much so that they can turn and start cutting rates, versus what we're seeing in the data today, which is none of the impact. Now, there's long and variable lags here, so that's going to make it challenging. But the reality is, and that's what you're seeing in the reaction in the front end of the curve, is that we still have a significant inflation problem in the most important driver of inflation, which is in wages and services.
I'm going to shift gears away from jobs over into personal consumption. This chart shows the blue line shows the trajectory of personal consumption. And what happened from 2016 through 2021, or through 2019, the personal consumption was on a trajectory, and the spending was on a trajectory. And then when the pandemic hit, personal consumption dropped. And then it very quickly recovered, people going back to spending more and more, having more and more confidence, until it gets in 2021, early 2021, up above the mean, the trajectory. And then it has remained there. And if you look at the end of this, it is even not only above it, but it's above it and still climbing higher. What this means is, when consumption is that high, what it means is oftentimes, and it certainly is true now, that people are going into debt, credit card debt. So the amount of savings that people have, money in the bank, savings accounts, is diminishing as personal consumption is higher. I think the feeling that goes with that is, I've got a job, my wages are going up, and it looks like I'm going to continue to have a job, and so people go and spend. And so what you see on this chart is the spike that goes up corresponds to the previous chart where the spike went down. So as personal consumption stopped, savings went up. And then conversely, when personal consumption began to rise, you see here, the money going into savings has dropped and is just dropping and dropping. But credit card debt is higher. CNBC's Tyler Matheson and Contessa Brewer interview Ron Insana and Michael Farr. The question is about consumer spending. As you saw, the chart suggests that spending is very strong. Just like the labor market, strong consumer spending gives the Fed more confidence and willingness to raise rates, pointing to a decline in the economy in 2023. So take a listen to this interview on CNBC.
Gentlemen, welcome. There's been anxiety, I suppose, Ron, about the pace of income growth that was revealed in this morning's numbers. But income growth is usually a pretty good thing, isn't it?
Yeah, Tyler, I'm tiring of some of the concerns that people have about wage growth, particularly with inflation coming down and crossing through that wage number that we saw. Inflation is beginning to fall below the increase in wages. So you're not looking at a wage price spiral if the two are not going up in tandem. And with a little more buying power and savings having been bought down rather dramatically, the savings rate now is at pre-pandemic lows. I'm not so sure why everybody's getting entirely concerned about this. And the Fed's got almost a Vietnam approach to this. They're going to destroy the village to save it by driving up the unemployment rate to get slack where we have no people. It's not that the labor market is so tight because the economy is overheating. Jay Powell himself said it this week. We are short human beings. Raising rates won't solve that.
You know, it's interesting, Michael, because I'm very closely watching what's happening in Las Vegas and the spending that's happening there. And they're just printing money on the Strip. They're pacing 20% of all of 2021 by the end of October. When you look at that, I don't know, you got to ask, are rumors of the economic demise greatly exaggerated?
Yes and no. The consumer has been sort of revenge spending. You've heard about revenge travel, sort of pent up from the great pandemic. There's sort of revenge spending now, too, I think. And people are feeling better about these increases in their paycheck. Even if those increases in the paychecks aren't keeping up with the increases in prices at the store, they can't afford as much, they still feel better. Consumer sentiment is hugely important. How the buyer feels is hugely important. In an economy that's two-thirds driven by the consumer, it's really important to see if they have any money. Ron mentioned the savings rate. It's come from 9.3% to 3.1%. And the credit card balances are really on the rise. So the consumer is running out of wallet, even though the consumer isn't running out of attitude. At some point, the attitude runs into the inelasticity of wallet. I don't know if we're going to get there soon, but it's coming. In the meantime, spending is still on and the mood is still ebullient.
The Case-Shiller Housing Index is the benchmark is used to indicate the direction of the housing market. Robert Shiller, Nobel Prize winner and professor at Yale, is considered the expert on housing in the U.S. This chart shows this is a composite of 20 major cities and the housing prices in those cities. It is a month-over-month index. When you see the red circle on the left, this is the period of time of the housing crisis when we remember, how that worked, and it was not good at all. Houses dropped dramatically in prices, sales disappeared, inventory went up, etc. You can see what happened to the housing index in that time period, in the 2008 time period. Now, and then the intervening period. Then look at the far right of the chart and see where we are today. This is the Case-Shiller 20-city composite month-over-month home price index. We are getting down in the range and this is home prices, not home sales, home prices dropping at a pretty rapid rate on a composite basis with 20 cities. Now, obviously, with some of those cities, some are better off than others, etc. And those that are not part of this, each city is different, each region is different. But you can see that, and you know this from conversations you've had probably, that home prices are starting to come down. And this is an indication of that, not saying that they have dropped as much as they did in 2008, but if this continues for that period of time, what's that, 2 or 3 years or more, it probably would start to look like 2008. But at this point, it's moving in a downward direction. Then I show this also is the Case-Shiller index, but it's showing a 3-month change, not a month-over-month, but a 3-month change in prices. But when you see the 2008, the drop in prices in 2008, and then the drop now, it's significant from where prices were to where they're coming down to. The housing market is clearly slowing. John Fort of CNBC interviews the co-founder of Zillow to get his take on what the data that Zillow has is suggesting on housing. Here's this interview.
There's actually a lot to talk about with you, Spencer. I actually want to start with real estate because just called out Zillow there. You were involved with OfferPad coming to the public markets. And I'm curious about the impact of this quickly slowing housing market, rising rates on consumer behavior when it comes to retail investors and when it comes to some of these companies. What are you seeing?
Well, unfortunately, I think the housing market's a little bit worse than most people realize, because when you look at data like Case-Shiller, that tends to be a paired sale methodology, which means Case-Shiller looks at homes that sold in the period, say last month, and then it looks back at when the last time those homes sold 3, 5, 10 years ago, and it calculates the delta. But if you look at the median value of all homes in a geography, that's actually declining in many parts of the country. So housing is very weak. That's to be expected. The Fed wants this when they raised rates from, or when mortgage rates went from 3% up to the mid 6s on their way to the mid 7s. This is what you'd expect would happen, and it is absolutely happening. So housing is slowing rapidly. However, homes are still selling pretty quickly. And this is a bit of a mind bender. I think some people have a hard time wrapping their mind around. The reason for this is there's very limited inventory because of mortgage rate lock-in. So if you bought your home 2 years ago, 4 years ago, 10 years ago, you probably have a 2, 3, 4% mortgage. And it's very difficult for you to list your home now and buy at a 6 or 7% mortgage. So there are very few sales. There's not much inventory. Those homes are selling quickly, but the median home value is probably declining in lots of parts of the country.
Yeah, I'm going to shift gears from housing over to fuel, oil, energy, etc. We had a period of time earlier this year where gas prices went up significantly, and in each area, people saw rising in gas prices. And then in the last couple of months, we've seen those be moderated. And one of the issues, the reasons why they've been moderated is that we have peeled off quite a bit of the strategic petroleum reserve in order to bring prices down. That's not what the strategic petroleum reserve is for. However, it did soften prices. But it sets us up for another problem. So I saw this article in the Epoch Times. The oil industry executive warns of another major crisis in the coming weeks. I saw this, it came out a couple of days ago. And the first sentence in the article was this: the head of the largest oil and natural gas trade association warned that failure to replenish the U.S. Strategic Petroleum Reserve could trigger another oil crisis, not in the coming months, in the coming weeks. You see, we are in the winter, and we've got several winter months in front of us, and the lack of supply and a constant demand is going to cause prices to go up. And I'm just saying this, not that you and I can do anything about it, but heads up, I think oil prices, gas prices, energy prices are going up. The most recent flow of funds report shows where money is going. Mutual funds, equity mutual funds had an outflow of $14.7 billion. Bond funds had an outflow of $6.8 billion, and money market funds had inflows of $29.9 billion. I think that speaks for itself. Be careful who you trust. Be careful for what they are selling. Buying what is hip and cool, Bitcoin or otherwise, may not be in your best interest. Think about it. Thank you for watching. If you have comments or questions, leave them in the comment section and I will try to answer them. Thank you again.